Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. Is the largest restaurant company by market share a good investment? In this video, we will be analyzing if SBUX stock is a buy. Cause Starbucks, stock ticker symbol SBUX, continue its share price rise even higher. Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Starbucks. Starbucks was founded in 1971 when three founders opened the first Starbucks in Seattle's Pike Place market. Growth continued from there with their commitment to high-quality coffee and a welcoming third-place experience. Today, the company offers a variety of coffee beverages, teas, pastries, and other food items. Starbucks boasts over 35,000 locations worldwide with approximately 383,000 employees and their headquarters located in Seattle, Washington. Now let's look at the price action. Starting with the one-year chart, we see that Starbucks had a CAGR of about 16%. Zooming out to the 5-year chart, we see that Starbucks had a CAGR of 9%. Brian Niccol taking over as CEO has been a great catalyst for the share price in the short term. Long term, Starbucks continues to be a steady grower. Now let's hop over to market share and take a look at Starbucks market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Starbucks is categorized as a fast food restaurant company. Expanding the fast food tab, we can see that Starbucks has the largest market share of the companies in this category and seems to be growing market share at a healthy pace. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Starbucks, SBUX, and see that the market share is 4.4% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Starbucks commands a strong portion of food spend and has been growing market share consistently. The 5-year market share CAGR for Starbucks is 4.02%. This means that Starbucks is slowly taking market share in the wider food industry. If we start in 2020, we see that the market share was 3.75%, 3.98% in 2021, 4% in 2022, 4.39% in 2023, and 4.4% over trailing 12 months. Starbucks has grown market share pretty steadily, but the growth has slowed in the past year. Let's take a look at the fundamentals to learn more. Gross margin is 26%. This is on par with other fast food restaurant companies. Revenue has compounded at around 11% over the past 5 years and has reached over $36.15 billion most recently. Sales actually declined in the past year. This is not what I like to see. When we look at cash flow, we see a 35% CAGR over the last 5 years for operating cash flow. CapEx has worsened at a 17% CAGR. As a result, free cash flow has grown at a 114% CAGR. To give context here, we are lapping the market downturn of 2020. Therefore, growth may be exaggerated. Still, Starbucks is clearly investing into new stores as CapEx has grown pretty steadily, which has resulted in free cash flow declining since 2023. Not good, but not dire. Weighted average shares outstanding have declined over the last 5 years, going from 1.18 billion shares in 2020 to 1.14 billion shares most recently. Starbucks has been very busy buying back shares. Starbucks does have a strong commitment to share buybacks, which I do like. Now let's view return on invested capital. Return on invested capital has grown from 5.8% in 2020 to 12% most recently, though down from its peak of 15.1% in 2023. The return on invested capital value is pretty decent. However, Brian Niccol clearly has his work cut out for him if he is to turn this company around. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 24 days in 2020 to 14 days most recently, Starbucks has gotten more efficient over time. Still, I would like to see this number be negative. There is still a lot of work to do. Now, let's look at Starbucks debt. The net debt to EBITDA has decreased substantially over time, going from 6.7 in 2020 to 3.4 most recently. While this value has ticked up from a low of 2.7 in 2021, Starbucks still has debt at much higher levels than restaurants like Chipotle and Texas Roadhouse. Last, let's explore dividends. Starbucks has a dividend yield of 2.2% and a payout ratio of 76%. While I would prefer this value be less than 50%, it seems Starbucks is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at an 8.9% CAGR over the past 5 years and a 15.1% CAGR over the past 10 years. Dividend per share growth has clearly slowed over time and may be an indicator of trouble brewing beneath the surface. There are few restaurant companies as ubiquitous as Starbucks. In any event, is it a buy? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Starbucks. It is a restaurant company with a gross margin of 26%. The 5-year revenue per share CAGR is 32%, and the 5-year free cash flow per share CAGR is 3%. The decent gross margin with incredible revenue and moderate free cash flow growth leaves more to be desired. A return on invested capital of 12% is okay, but getting worse. Next, the cash conversion cycle of 14 days is better than it has ever been. Still, I think the company could do much better by this metric. Concerning debt, a net debt to EBITDA of 3.4 means that it would take Starbucks nearly 3.5 years of earnings to pay off its debt. So from a fundamental standpoint, Starbucks is okay, but definitely not great. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 3.9, indicating that Starbucks is pretty overvalued relative to their projected earnings growth. The obvious strength of Starbucks is their brand power. People aren't just buying coffee, they're buying the Starbucks experience. They've got the loyalty program, the mobile ordering, and an increasingly comfy atmosphere is more than just a caffeine fix. Plus, they're still expanding, especially internationally outside of China. However, and this is a big however, we're seeing some operational hiccups. Costs are rising, things like labor and supply chain issues are eating into their profits, and that's showing up in their efficiency numbers. Basically, they're spending more to make less, and that's not a good trend. And here's where it gets interesting. While they're still grabbing market share, the rate of that growth is slowing. The good news is that their competitors, except Dutch Bros of course, are largely facing the same challenges. The revamp under Brian Niccol is just getting started, and if you're a long-term investor looking for a stable, dividend-paying stock, Starbucks might still be worth considering. For me, I'd like to see more signs of improvement plus a much more appealing valuation before adding to my position. Overall, I give this company a 5 out of 10 using my proprietary scoring system. Brian Niccol needs to restart growth and improve the company's fundamentals. In the meantime, I will enjoy being a customer of this legacy restaurant company. Many thanks for watching. What do you think about Starbucks? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now, and don't forget to put your money where your mouth is.